Warren Buffett's Berkshire Hathaway makes strategic shifts in portfolio as Apple stake shrinks and new winners emerge. In a noteworthy move that has caught the attention of investors and market watchers alike, Berkshire Hathaway Incorporated, the conglomerate led by legendary investor Warren Buffett, is adjusting its equity portfolio as it enters 2026. The firm's latest filings and market activity reveal a marked reduction in its long-standing position in Apple Incorporated, alongside increased concentrations in several other key holdings that now represent a significant portion of the investment portfolio. These developments highlight Berkshire's nuanced approach to portfolio management, blending long-term conviction with tactical reallocations that reflect changing market conditions and valuation assessments. Winds of change. Berkshire reduces Apple position. For years, Apple was among the most prominent single equity positions in Berkshire's famed portfolio, often cited as a cornerstone of Buffett's return to large technology bets. However, recent trading activity shows Berkshire trimming its Apple shares substantially. While the precise motivations remain subject to interpretation, analysts point to a combination of valuation discipline and risk management as potential factors. Apple's position, once representing a formidable share of Berkshire's total equity holdings, has now been pared back significantly. The reduction does not necessarily signal a lack of confidence in the company's fundamentals, but rather a willingness by Berkshire's investment team to rebalance exposures at historically high valuations and redeploy capital where it sees better risk-adjusted potential. Concentration rising in new leaders. As the stake in Apple contracts, Berkshire's portfolio is becoming increasingly concentrated in other major holdings. Recent disclosures show that 3 stocks alone now account for approximately 50% of the company's equity investment portfolio, underscoring a strategic focus on a smaller group of companies with robust competitive positions and durable earnings power. These 3 core holdings include financial giants and consumer stalwarts long favored by value-oriented investors. Their outsized influence within the portfolio reflects Buffett's confidence in their long-term prospects, even as some shifts occur within the broader mix of assets. Financial sector, a cornerstone continues. Among the dominant names in Berkshire's holdings are major financial companies, whose inclusion represents Buffett's enduring belief in the durability of certain banks and financial institutions. These positions have historically provided steady dividends and long-term capital appreciation, aligning with Berkshire's overarching investment philosophy that emphasizes predictable cash flows and strong balance sheets. The prominence of financial stocks in the portfolio also aligns with Berkshire's broader business model, which includes substantial insurance and reinsurance operations. The synergy between equity holdings and operating businesses underscores a holistic approach to capital allocation that has been a hallmark of Buffett's tenure. Consumer goods and insurance holdings hold strong. In addition to financial companies, Berkshire's increased concentration includes consumer brands with proven resiliency and pricing power. These names have weathered economic cycles and inflationary pressures, demonstrating the kind of stability that appeals to long-term investors. Their presence in the portfolio reinforces Buffett's historic preference for businesses with recognizable products, loyal customer bases, and the ability to maintain profitability across diverse environments. Insurance companies, both within the Berkshire corporate family and as independent equity investments, continue to play a vital role. The insurance float, the funds Berkshire generates from premiums before paying claims, remains a key advantage, enabling further investment and deployment of capital. What the exit from Apple reveals. Berkshire's decision to shrink its Apple holdings hints at a broader theme of portfolio discipline. While Apple remains profitable with a dominant position in consumer electronics and services, its stock valuation has in recent years reflected some of the highest multiples in the market. Berkshire's willingness to take profits, even from a historically successful position, suggests that the firm is sensitive to current price levels and opportunity costs. Investors often look to Berkshire's moves as a barometer for sentiment among value-oriented institutions. A reduction in a high-profile position like Apple is therefore seen not necessarily as a lack of belief in the company's future, but as an exercise in prudent capital allocation in a complex market environment. Implications for shareholders and markets. The evolving makeup of Berkshire's portfolio is likely to attract heightened scrutiny from analysts and retail investors alike. As Berkshire transitions capital from some legacy positions into others with perceived greater value or growth prospects, broader market implications may ensue, particularly if other institutional investors take cues from these reallocations. For shareholders of Berkshire Hathaway's Class A and Class B shares, the shift underscores management's adaptability and ongoing focus on risk management. It also reflects Buffett's and Vice Chairman Charlie Munger's enduring investment discipline, balancing patience with opportunistic repositioning when conditions warrant. Looking ahead, a portfolio in motion. As 2026 unfolds, all eyes will remain on how Berkshire continues to evolve its investments in response to shifting economic data, interest rates, and sector valuations. Whether the company further reduces its exposure to high-valuation technology stocks or deepens its commitment to traditional industries, these moves will continue to provide insight into thinking of one of the most closely watched investment organizations in the world. In a market characterized by uncertainty and rapid change, Berkshire Hathaway's latest portfolio adjustments illustrate the firm's commitment to a value-oriented philosophy, tempered by strategic rebalancing that seeks to optimize returns while managing risk, a balancing act that has defined its success over decades.